In this video, we will be talking about financial reporting and financial statements. But before we do that, we need to determine what a financial statement is. A financial statement is nothing more than a document showing in a quantitative way how your company is doing. There are three different ways of representing the financial state of a company. That is one from a cash side, then on the profitability side, and third, on the asset side. Each one of these questions is answered by financial statements, and that is the cash flow statement, the net income statement, and the balance sheet statement. Accounts are the categories in which the effects of transactions are recorded, and there are 5 different accounts by which we actually have developed our financial statements. The first one is the account of income, and the second one is the account of expenses. These two together make up or give us information about the operations and actually make up the income statement. On the other side, we have the account of assets, of liabilities, and net equity. These 3 show us the financial position of the company, and they give us the balance sheet as a financial statement of a company. The first financial statement that we will be talking about is the income statement. It's probably one of the most popular financial documents because it gives us a plethora of information regarding our company's success. First and foremost, it's important to note that this is a dynamic document showing us how well our company is performing during a period of time. So, for instance, from the 1st of January to the 31st of December. Second, the net income statement summarizes all the revenue generated by the company. It also summarizes all the expenses incurred by the company. It calculates the profit or loss of the company and tells us how well we're doing financially. It's nothing more than a basic equation showing us what's the difference between the income and the expenses. Technically, it tells us how well we're doing at the end of the year and if we've made any profits at all. When we review the income statement, we get a lot of information from it. First and foremost, we find out whether we're profitable or not and whether we should continue doing what we're doing. Then we find out what's our profit margin, what are our profits in terms of sales, and what is our gross profit margin, or that is what is the operating profit as part of sales. It also tells us what are the trends throughout the years and whether we should make any changes to our business model. So the chain of earnings is technically very easy to understand. We start with revenues and take out the expenses from them. What we're left with, in a very simplified manner, is something that we call EBITDA. It's the earning before interest, taxes, depreciation, and amortization. It technically tells us how well we're doing if we take out all of the other relevant aspects of our business. Then we move on to EBIT. If we take out the depreciation and amortization, what we're left with is the earnings before interest and taxes. And this is what tells us how well we're doing, taking into account the financial support that we've received in terms of loans. And in the end, we have EBT, or earnings before taxes. As long as EBT is positive, we have to pay a portion of it to the government as taxes. So what we're left with is net income, which tells us how profitable we are as a business. It's actually a very simple scheme to follow, and you should be able to recognize it when you look at an income statement. The next financial statement we'll be talking about is the balance sheet. Unlike the income statement, which has a very dynamic view, it's actually a very static financial statement because it only shows us the company's financial position at a single point in time. It has a very static view, and the balance sheet actually accumulates over the entire lifetime of the company and does not concern itself only from one year to the next. It shows us the net worth of our entire business, and the most important thing to remember about this financial statement is that the balance sheet always has to balance, and this is where it's derived its name from. It has an equation, which is technically an identity that always has to be followed, and that is that three main account categories have to be balanced. Assets always have to be equal to liabilities plus equity. If they don't balance, the balance sheet is not proper, and you should go back to it and work on it until it balances. Some of the examples of assets include property, plant and equipment, intellectual property, cash on hand, inventory, and so on. As far as liabilities goes, we have accounts payable, we also have long-term liabilities, and so on. Whereas our equity positions include retained earnings, capital in stock, and so on and so forth. There is a very distinct link between the income statement and the balance sheet, and you can find that in one position that repeats itself in both financial statements, and that is retained earnings. So every year we take retained earnings from the income statement and move it to the balance sheet, and this is how we tie these two financial statements together. There is something called double entry accounting, which means that every business transaction will affect at least two accounts. So if you enter something on one side of the entry, you have to make the same entry on the other side of the account in order to close the transaction, or otherwise you will not have a balance sheet that balances. So, for example, if you have to write a check to the newspaper for $100 to place an advertisement, first, your cash account will be reduced for $100, and second, your marketing expense account will be increased by $100, meaning that at the end, they will balance. There are two accounting methods that you need to be well aware of. The first one is cash-based accounting, whereas the second one is the accrual-based accounting. You record the first one when payment is made or received, whereas you record the second one when a business event occurs. There is a big difference between these two methods of accounting because it will make a difference in your income statement as well as your overall business success, depending on that, whether you count depreciation and amortization as part of that or not. So, what are revenues for a sports club or a sports organization? Most of the time, those are sales, and that is income earned by a club from its business activities. That means from selling tickets, from selling players, from selling merchandise. It can also be interest earned from firms or a club's investments. It can also be royalty or licensing payments for appropriate use of club's intellectual property. What are expenses? An expense is the cost of asset used by a company in order to generate a sale, and if you do not use an asset, you cannot create any sales. So please keep in mind there are two types of costs that are incurred by a club or any company whatsoever, and those are fixed and variable costs. Fixed costs do not change over time in the short term. Even if the club does not experience any change in its sales volume or other activity levels, the fixed costs will remain the same. Unlike them, variable costs will change with sales volumes, and they will reflect the changed aspects of the business operations. Fixed costs plus variable costs will give you the total costs of your club. The cash flow statement is the third statement that we will be talking about today. It's actually a financial document that records all the club's transactions that involve cash. And we can divide them into three different sets. Those are operations, financing, and investment activities. And the most important thing to remember about the cash flow statement is that we have to think in terms of what comes into the club and what leaves the club in terms of cash, or what we say in the financial jargon is what are financial inflows or what are financial outflows. Once we compare all of them, if we will know if the club is successful or not, and that is by knowing whether we have a positive cash balance at the end of the year or a negative cash balance at the end of the year. You might start hearing the word amortization and depreciation more often once you get into the business of finance. And if you need a definition for that, that would be the write-off of both tangible and intangible long-lived assets, most of them being property, plant, and equipment, or some goodwill, trademarks, and patents. This is something that is very important for accrual-based accounting, and which will figure prominently in your income statement. Please keep in mind that most of the assets that you have, especially if they're tangible, you will have to depreciate and amortize them by specific tables. Please refer to the specific tables that are in use in your country, or seek professional advice. Now that we know what financial statements are, we can move on to actually finding out some of the additional information that we can derive from them when we start comparing them one to each other. And we use that, or we do that by using financial analysis or ratio analysis, by comparing different positions from different financial statements. By doing so, we receive information that can be essential in determining how well our club is doing. So what are financial ratios? They show us the financial health of the company or the sport organization or the club, and they can be used as a diagnostic tool to tell us if we're in trouble or not. There's a number of different financial ratios that we can use, most important among them being liquidity ratios, as well as asset management ratios, debt management ratios, profitability ratios, and market value ratios. All of them have very specific formulas which you can look into more specifically in your course materials.